So Syfe was launched back in 2019, and in the early 2020, I was a customer of their REITs Plus portfolio. But ever since then, they've been consistently launching new and innovative products. And their latest is Syfe Core, which is a happy family of 3 portfolios that I've been lucky enough to be given an opportunity to preview and dig a little deeper into. So as a disclaimer, this is a sponsored video, but nevertheless, for those of you who might be new to my channel, my style is always to try and avoid the hype and try and provide you with as much of a balanced view as possible to help you make a decision. I'll give you a quick overview of what the product is, but more importantly, try and help you understand what truly makes this product unique. And after that, I'll run through a few key questions which I think a regular customer will want to know. Like, how does it really stack up versus Syfe's other products? Or maybe even other competitors out there. Hey guys, it's Sunman here and welcome back to Your Money Game, the show where we'll save, invest and feel better about money. So let's dive right into what I think are the 3 main things that make this product unique. First, it gives you access to a diverse set of different assets. Secondly, it's a portfolio that's built with research in mind. And finally, it's all guided by the principle of trying to balance risk as well as reward. So let's start with its globally diversified assets. Its portfolio is built with many different ETFs that gives you exposure to multiple countries. The bulk of it is US, followed by China, and then the rest of the world. And from the way I've looked at it, the ratios are pretty fair and it's almost comparable to what you would get when it comes to looking at another comparison type of ETF, for example, the Vanguard Total World ETF. And if you look at the underlying ETFs, you'll realize that it's also pretty finely tuned. So because US is a large section of their holdings, as you can imagine, they would be holding large indices such as the S&P 500, as well as the Nasdaq 100. But it doesn't stop there because they finally tune it a bit more to give you access to specific sectors as well. And the other country which I mentioned earlier was China. And this is relatively unique to Syfe Core because they have 3 ETFs in there that give you exposure to the country. It starts with an ETF called MCHI, which gives you a fairly diversified portfolio of about 500 plus Chinese stocks. This is then layered on with another ETF called KWEB, which gives you access to a much more concentrated tech portfolio of about 40 plus stocks. And finally, you'll have a little more exposure to China through another ETF of emerging markets called IEMG. Now, if you look at the underlying sectors, especially in the core growth portfolio, you realize that it's a little bit more tilted towards tech. Now, this might be a bit alarming for some of you guys, especially in the current market, where in the early part of 2021, tech has been taking a little bit of a beating. But if you looked at the underlying holdings of even core growth, you realize that QQQ is about 16% and KWEB an additional 4.5%. Now there is a reason why the portfolio is tilted towards those type of tech, and that brings me to the second point about this portfolio, which is that it's research-backed. The first part of research-backed is easier to understand. It's a portfolio that has been researched to not only go back in time to about 2013, but also assessed of its performance of how it will do in the future. The other thing about its research is the smart beta factors that I brought up earlier. Factors are simply characteristics of a stock that explains why it does well. Now, to help you understand, imagine if you were in a cake baking competition and somebody told you that, hey, I know exactly what makes a great chocolate cake. So the first factor is moisture levels. Is it a dry kind of cake or is it a moist kind of cake? And secondly, it's the levels of cocoa. Is it more of a milk chocolate kind of cake or is it more of a dark chocolate kind of cake? So think of those as just factors that make a great cake, and in the same way, they are factors that make a great stock. Syfe Core uses 3 main factors. The first is large cap, which is basically just large companies. Second, it is growth companies that tend to be growing their earnings very quickly, and that's why you see there's so many tech stocks there, because tech stocks tend to be the ones that are growing fast. And finally, it is low volatility, and you'll see this with the underlying ETFs like XLP, which are consumer staples, and XLU, which are utilities. Now, all those things put together are there to try and deliver to you the best risk-adjusted returns, which brings me to my last point, which is how it balances risk versus reward. And the first level of choice is the choice between its 3 portfolios. You've got defensive, like the name says, it will be quite defensive, and you've got balance, and then you've got growth. While they each hold nearly an identical set of ETFs, what you'll realize is that because stocks are the riskiest asset, the ratio of stocks between the 3 portfolios goes upward the riskier it gets. So growth currently holds about 68+% of its portfolio in stocks, balance holds about 40, and defensive holds about 20. So picking the right portfolio is the first level of risk management for yourself as a customer. The next is that term that you'll see in its website called risk-adjusted returns maximization. Whoa. Now, I'm no fan of technical jargon, so here's my layman explanation of what that really means. You know that saying, no risk, no reward? So it's a little bit true when it comes to the stock market. But if you think about it this way, there's no living customer that says that, hey, there's no such thing as too much risk, I'm gonna go for it.
No.
But maybe if you're one of those guys that are YOLOing into GameStop, power to you. But jokes aside, it's really all about balance, right? You want some reward, but you want to manage the level of risk that you're willing to take to get that reward. And that's why when you look at the underlying ETFs, you might be wondering like, why are there so many of them? But it's all intentional because they're putting it there as a way to find that best balance and ratio. So those are the three main things that I think make the product relatively unique. Now, let me put on my customer hat and go through some key questions you might be thinking about. Now, the first question for most interested customers is usually about how does it perform? And I've got a really neat chart over here that shows you the different years and the different levels of performance. Now, if I were you, I'd pay attention more towards the long-term averages. And on top of that, I would also pay attention to the maximum drawdowns. Now, drawdown is simply a technical term to explain how far did it fall from the peak to the bottom. Now, this is important for those of you who are perhaps a little bit more risk averse. The next question could be, how does it compare to Syfe's other product, which is Global RE? Because they do look like they're fairly similar. Now, there's a product page that kind of does all that, but I want to give you a quick summary of what I think are the core differences. Think of Global RE as a portfolio that's built with the downside protection as the primary consideration. Syfe Core, on the other hand, is built with risk-reward maximization, which is really trying to find that balance. To me, the other big difference is that the Global RE portfolio is more dynamic in nature. Like for example, in March of 2020, when the markets crashed, Global RE actually shifted its different assets as well. When it comes to Syfe Core, its assets are more stable, so you shouldn't expect it to shift around often. There's a twice a year rebalancing, but that's really just getting the ratios back into order. So it's not really new assets being introduced or swapped out. And it's the stability of these assets that make a portfolio like Syfe Core a little better when it comes to dollar cost averaging in. But what about Syfe Core versus Equity 100, which is Syfe's other popular product? Equity 100, like the name says, it's 100% in equities. So in some ways, you can think of it as the riskiest of the different offerings that Syfe has. Also, Syfe Core is built to give you a bit more exposure towards China, whereas for Equity 100, you do have an ETF there called IEMG as well, but the allocation towards China within that portfolio, it's a bit of a small one. But how does it compare to the other robo-advisors out there? I'm personally a customer of StashAway and Doubtless as well as Syfe. Now, they all three have their own unique way of approaching the markets, with unique products as well. I tend to think of StashAway and Global RE as fairly similar because they are more dynamically managed portfolios that try and understand what's going on in the economy to manage the underlying assets. Endowus, on the other hand, chooses to focus on the main academic research that I mentioned a little bit earlier about factors. And the factors that Endowus focuses on are different than what Syfe is focusing on. Now, I personally think that all three have done a very good job in treating me as a customer. They all have pretty good systems, pretty good apps, and on top of that, they're pretty good at releasing information to help me feel comfortable as a customer. So I personally always encourage people to just, hey, shop around, see what approach makes sense to you. The other question could be, is there anything in this portfolio that I should be mindful of? The first is its Chinese holdings, and you'll see that very clearly once you move from defensive to growth, because in that jump, you'll see a ratio of about 3% bloom to about 14%. Now, I'm personally okay with this because in my own portfolio, I have a roughly similar ratio allocated towards China. Now, if you've not invested in China before, you might need to be aware that the Chinese market can be a bit more volatile. And in particular, if you look at the two main Chinese ETFs, which is MCHI and KWEB, you realize you'll end up holding quite a lot of the three biggest tech names there. and that's Tencent, Alibaba, and Meituan. The next thing is related to the factors research, which I brought up earlier. Large cap growth is actually opposite of what the long-term research has found, which is small cap value. Now, this is getting a little bit geeky, but it's important to understand where the research came from and why they're doing it in this way. Now, there's a very good reason that Syfe chose to focus on large cap growth, because in the past nearly 15 years, those two factors have really outperformed small cap value. Richard Ye, who's the head of portfolio construction as well as risk management, has his eye on those factors. And what I'm comforted by is that he's not rigid about it, but he has his views about why he thinks that large cap growth will continue to outperform. I think investors should be comforted by the fact that they can look at the academic research and then look at Syfe's approach and try and come to their own conclusion, because it's easier to understand the basis of decision making. Now, here are some final quick facts for a potential customer. Starting with fees, the way Syfe charges you is similar to how they would charge you for managing any kind of money with them. The more they manage for you, the cheaper it will get. And it starts at 0.65% and then it goes down all the way to about 0.4%. The only exclusion is Cash Plus, where they don't charge you any money for managing your money, but at the same time, they don't take that amount and factor it in when it comes to calculating the overall fees as well. You can't have it all, right? Besides those fees, there are the underlying ETF fees as well. Now, it is Syfe's promise that it is roughly going to be about 0.15% as the total aggregated expense ratio. And that just simply means at the end of 1 year, your total management fee is going to be roughly about 0.8-ish%. Now, the final thing for newer investors who might be a bit more nervous about where they're sending their money, all your deposits and assets are held in different custodians such as DBS, Saxo Markets, and HSBC. And this is separated from Syfe's own funds. And on top of it all, Syfe is of course MES licensed, so you know that at the end of the day, hey, the Singapore government's got your back. And if you have any other questions, please feel free to leave it in the comments below. And if I can't answer it, I'll relay it to the guys at Syfe as well. Now, I hope you got a lot of value out of this, and if you did, I would really appreciate your support in clicking that like, subscribe, as well as that bell button, because I'll be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.